Good morning to everybody joining us from in Europe. Good afternoon for those of us joining us from Asia, and good day and thank you for all of you joining us on their weekend in the Middle East for UBP's webinar on the strategic case for gold. My name is Norman Villamin, and I am the Chief Investment Officer for UBP's wealth management business globally. As those of you who have participated in our 2020 investment outlook series at the end of last year or even early this year, at UBP, we've outlined the important role that gold is going to play in investment portfolios in the decade ahead. In the face of the global pandemic, at our mid-year outlook in June, we doubled down on this message. And it's against this backdrop that I'm really excited to host this webinar to delve more deeply into this most precious of metals, which for many investors has sat at the periphery of portfolios for many years. To outline the case for gold as the ultimate store of value and wealth looking ahead, I'm pleased to have joining us today Mr. John Reade, the Chief Market Strategist and the Head of Research at the World Gold Council, the leading experts on the gold industry. John joins us with a long and esteemed career as not only a strategist advising investors on their gold investments, but also bringing with him industry expertise with one of South Africa's leading mining houses. Joining John, I'm excited to have Peter Kinsella. Peter, as many of you will know, is UBP's Global Head of Foreign Exchange and our own resident gold expert. Before I hand it over to Peter to set the scene for John's strategic perspective, for those joining via the WebEx app, you can submit questions at any time using the Q&A chat box. For those joining by phone, please submit questions to investments@ubp.ch, and we'll address them all during the Q&A session at the end of the formal remarks. With that, Peter, can you help set the scene for John?
Indeed, I will. Thank you, Norman. A very good morning to all of our clients and a good afternoon to our clients in Asia. I would also welcome John to the presentation. We'll get started basically by bringing you to the first slide in our presentation, where we talk about what's happened with gold over the last year or so. Just bringing you to the following slide, in which we will show you how gold has basically fared over the last 12 months. In June of 2019, here at UBP, we changed our view on gold. And at the time, that was sort of, I would say, quite early in the broader gold up move. And the reason for this was that we saw a very large pace and scale of coincidental monetary easing by a large and wide variety of various central banks. We saw obviously the US Federal Reserve cutting interest rates, and then additionally the European Central Bank in September of last year, but also a number of smaller and regional central banks, such as the Reserve Bank of Australia, the Reserve Bank of New Zealand, the Reserve Bank of India, Central Bank of Russia, Central Bank of Brazil, etc. And really what we saw was that this broad coincidental monetary easing, of course, is very good for gold, basically, which will retain its value in an environment of various currencies trying to depreciate themselves against one another. So certainly our view on gold was quite, I would say, quite early, but indeed quite prescient. Over the course of the last year, we've certainly seen gold continue to rise, and we entered sort of 2020 in and around levels of $1,500 per ounce. Of course, immediately gold shot higher. We then had the tensions in the Middle East, followed by the COVID-19 outbreak. And certainly the response from the fiscal and monetary authorities to COVID-19 has been quite predictable in a sense. As soon as it became very clear and apparent that we would see very large and wide-ranging lockdowns, central banks immediately cut interest rates very aggressively and restarted their various quantitative easing programs. The difference, of course, is that I would say the scale and the tenor of the quantitative easing programs far surpasses that of the 2008-2009 global financial crisis. So we're seeing a pace and scale of monetary easing which we've never really seen before, and we think that, of course, that this is highly constructive for gold. In particular, the use of negative deposit rates and negative deposit rate policies is, in our view, a very sort of a harbinger of things to come. And of course, we basically think that this is highly stimulative for gold prices. Bringing to the following slide, we'll look into it in a bit more depth. And what we can see from the chart on the left-hand side is basically how gold it trades as a function of broad money growth in the United States, also known as US M2. And the development of broad money growth in the United States, as you can see, has skyrocketed in recent months as the Federal Reserve has engaged in a very aggressive quantitative easing program. And certainly what we're seeing at the moment is that gold, in our view, certainly has scope to continue its rally. And if gold, if we think that it maintains its old relationship or old correlations with broad money growth in the United States, this is indicative of gold fair value in and around levels of $2,200 per ounce. And our forecast is that we will get there by December of 2021. Certainly the price action does suggest that there are upside risks to this forecast at this point in time. The broader sort of outlook in the United States and of course more globally is highly constructive for gold. We are in an environment of negative real interest rates, as you can see from the chart on the right hand side. And what this tells us is that the opportunity cost of holding gold is no longer severe. Certainly what we find is that gold trades with an inverse relationship to real interest rates. As real interest rates decline, gold tends to increase. And certainly the outlook both now and in the immediate coming years is going to be highly constructive for gold, because not only will the United States run a negative real rate profile, but this will also be the case around much of the developed and increasingly the developing world. So in a broader sense, we think that the real interest rate profile is highly constructive for gold. Bring you to the following slide. We can then look at the actual sort of the change in investor behavior. And what we've seen this year, certainly between March and June of this year, was that investors sort of have basically closed a large number of the open interest in the futures market and have gone and taken physical delivery of gold. And this is a highly interesting development in our opinion. And investors took huge quantities of gold, nearly 250 tons of gold were taken in physical delivery. In our view, it's a qualitative shift because this does indicate that investors are in gold for the longer term and are certainly not going to change allocations based on 1 or 2 months of possibly downward price action. So in our view, this is a highly significant development for gold. Bring you to the following slide. We can then look at sort of what's happening in terms of the Fed balance sheet. And US Federal Reserve balance sheet expansion is of course highly supportive for gold. And over the coming weeks and months, we do anticipate that Fed balance sheet expansion will continue apace. And of course, we think that gold is likely to move higher on the back of this. The interesting thing about it from a positioning perspective is that investors have not really increased their financial net long positioning in the CFTC futures market to any great extent since March. And indeed, it's only in the last week or two that we've seen this, investors put on long gold positions again. So in a sense, certainly financial investors who are investing in financial gold, they've kind of missed the up move to a large extent. And consequently, we think this is going to lead to an environment where dips in gold are going to be rather shallow. They're not going to be all that long lasting. And indeed, we'll see investors jumping in and getting stuck into long gold positions. Bringing you to the following slide, we can then look at the options market. And what we've seen in sort of the options market is quite interesting. Gold volatilities and indeed implied volatilities have fallen since the highs which we experienced during March. And so the volatility base in a broad sense is now much more calm and much more serene than was the case a number of months ago. However, this lower volatility does not hide or should not hide the large skew that we're seeing in the options market. The chart on the right-hand side shows investors the so-called gold volatility smile. And what this shows you is that there is a large bid to, let's say, lower delta gold calls, at pretty much every single tenor, 1 month all the way through to 12 months. And what this chart simply is telling you is that gold investors in the options market still anticipate significant upside for the gold price over the coming year. And over the longer term, as we'll show you on the following slide, the options market is indeed still very constructive on the gold price. The chart you're looking at basically is what is known as the gold volatility surface. And what this shows you is the level and the tenor in terms of expiry on the right-hand side and the delta of an option. And you can see from the area in the red, which is shaded in the red, basically that longer dated options in the 1 year up to 10-year feature are, and indeed at lower deltas, or the so-called 5C, you can see, they're trading with a very advanced premium. And what that's telling you is that investors are getting ready for huge increases in the gold price over the longer term. This could manifest indeed as central banks move towards an implicit and in some cases explicit monetization of deficits This, of course, is highly constructive for the gold price. Indeed, if we see central banks moving towards so-called helicopter money policies, which basically involve sending checks to every single bank account in the world in order to increase the overall inflationary outlook, this, of course, could be very, very stimulatory for gold. So the broad sense for us is that we see a number of factors which continue to support the underlying developments in the gold market: the monetary policy outlook, the negative real rate outlook, and of course the broader sort of central bank easing outlook, both in the United States and indeed around most of the developed world. So broadly speaking, we do remain very constructive on gold, and we think that we're likely to continue the up move from current levels, even though we've already come quite far. And with that, I'll now pass you over to John Reade, and John will cover things in the supply and demand in far more detail. Thank you.
Thank you very much, Peter, and thank you, Norman. It's a great honor to be given this opportunity to talk to the clients of UBP this morning. So I'm going to talk about a couple of things this morning. I'm going to talk about the strategic case for gold. I'll give a brief gold market update. So if we can turn to the next slide, please. Before I do, I'd just like to introduce the World Gold Council. We've been around for more than 30 years now. We've been established by the leading gold mining companies of the world to disseminate knowledge and expertise about the gold market. And we do that in a number of ways: data, analytics, research, market knowledge, through my team in research and strategy. We also conduct some policies to open up gold markets, and when necessary, actually get involved in the physical market infrastructure for gold trading. On the next slide, as I mentioned, I'll talk about the strategic case for gold. Now, this is typically the case that we make to investors, both institutional or high net worth investors, about why gold should be in your portfolio pretty much all the time. If you turn to the next slide, I'll explain further. So this is from the perspective of an institutional investor. And we think gold fits very well into a portfolio for the following reason. If you think about what investors are looking for, they're looking for returns, they're concerned about market volatility, they have illiquidity risk, and they're interested in capital preservation. Gold's characteristics can satisfy all of those. It's been a source of returns. It's diversification that works when you really need it. It's a liquid instrument, and it has a good impact on portfolios. And I'll run through these arguments one by one. First, turning to returns. People think, on the next slide, please. People think of gold as something that does well during financial crises. They think of it as something that does well during periods of high inflation, or indeed during coronavirus crises, as we're seeing at the moment. But that's not all gold has done. If you look at the returns in gold over the last 10 years, over the last 20 years, or since 1971, when gold was freed from its dollar peg, it's produced returns which are consistent with or in excess of other major asset classes. Really, it's only over the last 10 years, note that these returns are to the end of December 2019, so this picture will have changed somewhat since then, but it's only over the last 10 years that gold's performance has been overshadowed by the strength of the US equity markets. But that in itself may present an opportunity. On to the next slide, please. Gold's not correlated to risk assets in general. So if you look at the correlation of returns of gold versus the S&P 500, on average, it's virtually zero. But you can do more than that. You can break up gold's correlation during certain events. So if you look at what happens when the S&P 500 is up by more than 2 standard deviations in a week, gold's positively correlated, small positive correlation to the S&P 500. And that's good, because you're correlated to an asset that's rising rapidly. But if you look what happens when the S&P 500 is down by more than 2 standard deviations, that correlation flips. So now you're negatively correlated to something that's fallen quickly. So not only is gold uncorrelated in general, but it's negatively correlated to the S&P 500 and thus risk assets in general when those risk assets are selling off rapidly. On to the next slide as well. It's a liquid market too. If you look at the amount of gold that turns over a day, we're looking in excess of $120 billion a day. And that's in a mixture of markets. The over-the-counter market centered out of Europe, principally London and Zurich, is responsible for about 2/3 of global volume. And then we have various futures markets around the world, COMEX in New York, Shanghai Gold Exchange in China, and Tokon in Japan. Collectively, they make up about 30%. And then there's various other markets as well, such as the exchange traded fund market. So gold's big, it's liquid. It's more liquid than German bonds, US corporate bonds, US T-bills, surprisingly. Only the S&P 500 and 1 to 3 year treasuries really are bigger in terms of daily liquidity than gold. So you can get into a position, more importantly, you can get out of it as well. The next slide shows the combination of returns and diversification working for a portfolio. And to do this, we looked at a typical US pension fund portfolio over the last 10 years, based on research from Willis Towers Watson, that has no gold in it. What we then did is we put in 2.5% gold, 5% gold, 10% gold, and ran this portfolio over the last 10 years. And despite the last 10 years being the lowest returns for gold and the highest returns for US equity, what you can see is that adding gold to the portfolio increased your risk-adjusted return for each of these additions for gold. And what you can see is, generally speaking, the more gold you added, the better the risk-adjusted return. And it looks like it tops out somewhere between 5 and 10%, which is what our analysis shows for a typical US portfolio. Every portfolio is different, however, and generally speaking, the higher the exposure you have to risky assets, so either equities or things that correlate well to equities, the better or the larger the justification for having gold in there, which makes sense because gold is such a good diversifier of equities. On to the next slide, please. So we've argued that that gold should be a part of almost all portfolios almost all the time. Now, the exercise that I've just spoken about was one that was conducted in US dollars. We've done this work in many other currencies, many other typical asset portfolios, and the story is basically the same. We're busy working on one at the moment in Swiss francs, which may be of interest to your clients, which, as I say, we'll certainly pass on at the right time. So just a brief comment on gold year to date. On to the next slide, please. We put this together in our Outlook 2020 update, which we put out in the first few days of July, showing just how well gold had performed compared to other asset classes. It's now a bit out of date when you look at the moves that have happened over the last few days. But again, you can see that gold has been the best performing major asset class this year. Next slide, please. And I'm not going to talk too much about the performance this year, except to say that the strength in gold in 2020 has not just been a US dollar weakness argument. Often gold does really well when the US dollar is weak. But the US dollar hasn't really been weak this year, at least not until the last few weeks. What we've seen is we've seen gold perform well in a stable to perhaps strong US dollar environment. And that's really important because it means it's not just US dollar-based investors that are seeing the benefits of the increase in the gold price. We've seen gold hit record highs in multiple currencies. Now, we were about 1% away from the all-time high in US dollar gold overnight, but it's hit that in virtually everything. And I think the Swiss franc is perhaps one that it hasn't. Not a currency I spend as much attention to as I used to when I worked at UBS, so I apologize for that. On to the next slide, please. So what's been happening in the gold market in terms of supply and demand? Now, we'll be releasing our second quarter estimates of demand in the gold market, actually in exactly a week's time. So we're busy preparing the report for that at the moment. It takes a little while after the end of the quarter to collect all the data from the various markets around the world. But I can certainly talk about what we saw in the first quarter and the themes that are continuing into the second quarter. So it's really a tale of two different markets. We've heard from Peter about investor demand and investor interest in gold and why gold is doing well from an investor's perspective at the moment. But we shouldn't ignore the consumer market as well. Normally consumer markets, so primarily jewelry and some technology demand, makes up more than 50% of annual gold demand. And that's pretty weak at the moment. Central banks have been an important contributor to purchases in the gold market in the last 10 years. And they still continue to buy, but at a bit of a slower rate than we saw before. And then don't forget supply. So gold supply is obviously a physical operation. You have to get into the mines and dig the gold out of the ground. You have to process it. You have to refine it. You have to turn it into bars. You have to ship it where it needs to go. All of these things have been affected to a greater or lesser extent by the lockdowns from the coronavirus, and I'll talk a little bit about that. And then finally, we'll just look forward and see what we're expecting from the demand and the supply market in the future. So next slide. Now, in the interest of time, I'm going to talk principally about three markets. I'm going to talk about the jewelry market, I'm going to talk about the ETF market, and I'm going to talk about what's happening with central banks. So this chart here shows demand for the first quarter of 2020 versus first quarter of 2019. And you can see the big changes in demand that have taken place. Q1 2020 global jewelry demand fell sharply and was the lowest that we've seen in our data series. Principally, if you think about where jewelry demand comes from, India and China make up more than 50% of global jewelry demand. Chinese gold market, along with everything else, was pretty much locked down for most of the first quarter in China. In India, where demand fell only 41%, that lockdown only came in March. So those two markets will continue to be affected in the second quarter. It's worth pointing out as well is that every jewelry market that we examined around the world saw a year-on-year decline in jewelry demand. So yes, the investment side of gold is positive, but the consumer market's been very weak. The best place to see the strength in the investor market is through the ETF market. So ETF demand in the first quarter was just shy of 300 tons, and that was up 600% year on year. Now we have the data for ETF demand. We collect about 90 ETFs holdings of gold every day. We publish it every month, and the data is available on our website as well, which I'll mention at the end. So we know what's happened in the second quarter as well. So collectively, first half of the year has seen 734 tons of gold go into ETFs. So we can put that into context. That's more than the record central bank buying that we saw in a full year in 2018. That was 656 tons. What we've seen in the first 6 months of this year in ETF buying is more than we've seen in any one full year. ETFs now hold more gold than every central bank in the world except the Federal Reserve. So in the first half of this year, they've overtaken the roughly 3,400 tons that's owned by the Bundesbank. And updating the numbers this morning while I was waiting for this call to start, in July, those purchases have continued, another 124 tons month to date. Next slide, please. So what's the outlook for gold demand going forward? The clear story the first half of this year will be one of investor strength, principally visible via the ETF market, but taking place in other markets too, in the OTC market, which you can't measure, and in Western bar and coin demand. So that looks set to continue. As we heard from Peter earlier on, we're at something of a perfect storm, I think, for Western investment in gold. So the overall picture for gold for the balance of this year and perhaps beyond will be dependent on this ability of investment demand to offset the weak consumer demand, which is set to continue. We'll see an even worse picture, we expect, for jewelry demand in Q2. And although we'll probably see improvements in jewelry demand in the third quarter and the fourth quarter, it's going to be a poor year overall, even if we have a V-shaped recovery in demand from the jewelry sector. But it will recover, and that's really the second issue, I'd say. So what would happen if consumer demand, jewelry demand principally, recovers while investment demand stays strong? Then we'll have both major elements of the gold market fire. That could be really interesting. Now, of course, the recovery in consumer demand and the ongoing triggers for investment demand will depend upon the performance of the global economy, and which letter will characterize the recovery. Equity markets, particularly in the US, seem to think will be a V-shaped recovery, which seems unlikely. L-shaped, U-shaped, W-shaped, you pick your own scenario, really. All of these seem to suggest that investment demand will be supported. And if you're interested, we've developed a valuation framework for gold, which looks at the drivers of demand and allows you to input your expectations for economic growth, etc. There's a valuation tool called Quorum. Q stands for quantitative, Quorum stands for gold. It's not a spelling mistake. I personally hate the name, but we had lots of arguments about that. So the Quorum valuation tool on our website can help guide you in terms of the potential performance of gold going forward. Next slide, please. I was set this challenge by one of my sales guys for a presentation I delivered yesterday. And he said to me, John, he said, okay, you've got hundreds of slides, you can talk about gold all day. But what three things should I keep an eye on in gold for the balance of this year? What will guide me about what's happening? So I've shown them here in charts. One of them, Peter actually discussed already, and that's the relationship between gold and real US rates. If I had one market data feed to know what's going on in the gold price, I would be looking at real US treasuries. That's correlated really well since just before the financial crisis. And if bond yields, real yields in the States continue to plumb depths, gold will go higher. The second thing I'd say is I don't look at the positioning on the COMEX futures market very much anymore. And that's a shame because that's a spreadsheet I built in the 1990s and I've updated ever since. Problem with COMEX, and Peter alluded to this before, is investors are not participating in the COMEX market as much as they were. Something we could discuss in Q&A if you're interested why. What we have seen is a migration of investment interest towards the ETF market. So the monthly, in fact, daily flows into ETFs have become really, really important as a way of tracking investor enthusiasm into gold. So the chart on the bottom right, it comes from our data, comes in the monthly ETF flow report that's again available on our website. But also I tweet this out on a daily basis pretty much now, looking at the changes in ETF holdings overnight. This chart's slightly out of date. I put it together about a week ago. The July number is now about 124 tons, as I mentioned before. The final thing I'd say I'd look at is something that captures consumer demand in key markets. So you could look at, well, I've shown the Indian local market gold premium here. You could look at Shanghai Gold Exchange, physical turnover on the 4 nights contract. You could look at Indian gold imports or Chinese gold imports, something that would give you a leading indicator on the recovery in the consumer markets. Because as I say, those consumer markets start to fire while investment demand is strong, that would be extremely supportive of the gold price. Final slide I think I've got next I've mentioned our website on a number of times. We launched this site for all our data research at the beginning of last year, called GoldHub.com. Pretty much all the data that has fired the presentation I've given now is available there. All the research that we publish on gold, including the strategic case for gold, can be viewed there. There's also a couple of tools. I mentioned Quorum, the misspelt gold valuation tool, but also there's a portfolio simulator which allows you to select asset classes that you are invested in and see what the benefit is of putting some gold into that portfolio as well, in terms of both your returns but also your risk-adjusted returns. So I'd encourage you to go to our website. I'd encourage you also, if you are users of social media, to follow me and follow the World Gold Council. Since we're locked down and I'm stuck in my beautiful home office, we're spending an increasing amount of time in front of Bloomberg screens, in front of gold market charts, and I'm throwing my thoughts out there multiple times a day. Thanks very much. I'll hand back to Norman.
Thank you, John, and thank you very much for your presentation. Look, with that, on behalf of UBP, I'd like to thank you, John, for joining us, Peter, for sharing your thoughts, and everybody who's on the line for taking the time to join our webinar on the strategic outlook for gold. If you're interested in more and a follow-up on a lot of the work that Peter does, you can visit us on ubp.com. Sign up for the newsletter and you can get regular updates from Peter on gold, as well as the whole range of asset classes that we look at. Thank you for everybody for joining. If you do have questions, feel free to email us again, and we certainly will get back to you.